Alrighty then, as promised, chapter 18. Chapter 18, the last chapter that we're going to cover. And so we looked at commercial lending in chapter 17, and now we're going to look at consumer lending. Consumer lending, okay? So consumer debt, that's lending to individuals and families, is one of the fastest growing line items for banks, okay? And I thought this was interesting. I looked this up. There's approximately $14 trillion of consumer debt in the United States, 14 trillion, and that compares with 22 trillion that the federal government has in debt. So we talk a lot about the federal government debt of 22 trillion. You hear that in a lot of political contexts, but you don't hear nearly as much about how much consumer debt that we have out there. So I thought it was interesting to throw that out there, 14 trillion. All right. So banks dominate consumer debt, and the reason they do is they have a connection with individuals and with families, and that connection is checking and savings accounts, okay? And that connection was even stronger back in the day when you had to go into a bank to make a deposit, and you had to take your paycheck to the bank. And so all that has changed, and so the connection with the bank is not as strong as it used to be, but there's still a lot of banking that goes on between individuals and commercial banks, and so that brings people in contact with the banks, and so banks are top of mind when it comes to who am I going to borrow from. Whoops. All right. So the book makes a point of the fact that consumer credit, lending to individuals, is a very profitable operation, okay? But it can also be costly and risky. And I'm going to show you some data that kind of backs that up, why it's costly and risky, or how you can measure that it's costly or risky. So, what kind of consumer loans are being made out there? If you go into a bank, talk to a loan officer, the purpose of the loan, okay, so what someone is going to do with the loan proceeds is one way of classifying a consumer loan, and then how a loan is going to be paid back is another way of classifying a consumer loan. So will it be paid back in installments, which will be a level pay, the same payment on a regular basis, and it'll be amortized, which means that when a payment is made, part of the payment is interest and part of it is principal, okay? Or will it be a lump sum, which means there'll be simple interest charged on the loan, and we'll go over simple interest, we did that in ManFin, with a balloon payment on one date. So simple interest means there's no principal being paid along the way, and then boom, at one point in time, the bank's going to say, you need to pay all the principal off. And typically, what happens at that point is you roll the loan into a new loan. And so you don't dig into your pocket at that point to pay the loan off. You roll or renew the loan. Now, sometimes you'll sell, if you use money, loan proceeds to buy an asset, and then you sell that asset, you use the proceeds from the sale of the asset to pay off the balloon payment of the loan. Okay. So we have residential loans, okay, and this is credit that is used to purchase a home or to fund improvements on the home, a private residence, not commercial, okay? And these are usually long-term loans, typically 15 to 30 years, okay? There are shorter terms, there are 20-year terms as well, and the loan is typically secured by the property itself. Okay? And so the bank will get a mortgage lien on the property, meaning that the bank will actually get temporary ownership of the title of the property until the loan is paid off. And then it becomes yours. So you actually don't own the house, you own it with the bank. All right? And they may either carry a fixed interest rate or an adjustable interest rate, typically. And banks are by far the leading residential mortgage lenders today. Although the federal agencies own a large amount of mortgages, and you heard Daryl Welch talk about this. Okay? And then there's home equity lending. And home equity lending is when borrowers use the equity in their homes, the ownership that they have above and beyond what they owe. So equity is going to be the market value of your house versus the debt in your house. Let's see if that's on. Yeah, there it is. So equity is the difference between a home's estimated market value, what you think you could sell it for, and the amount of debt that is outstanding against it. Okay? And there are two main types of home equity loans. The traditional home equity loan, which is paid off in installments. Okay? It's an installment loan, typically with a fixed rate. Or you have an home equity line of credit, and that allows you to borrow, repay, and borrow again, and that typically will have a floating rate. So you often will have the choice if you're setting up a home equity loan, and you can use home equity loans for anything. You don't have to use a home equity loan to improve your house. You can use it to pay medical bills, you can use it to pay education costs. All right, then we have non-residential loans, and these are installment loans, and they're used to buy big ticket items like automobiles, boats, furniture, appliances, or sometimes they're used to consolidate other household debts. So any debts that you might have, you'll roll them up and you'll take out a loan from the bank. And typically, the reason you do that is you'll get a lower rate on the bank loan and you'll get a longer term to pay it. So a lower rate and a longer term means that your payment is going to be lower, and that's what you're trying to do. Give yourself a little breathing space, okay? And so they're often short to intermediate term, and they're paid either monthly or quarterly. Then you have non-installment loans. We mentioned those before, and they are repayable in a lump sum or a balloon payment, okay? And then there is the credit card loans and revolving credit at a bank. And so banks, you might have a Visa or you might have a MasterCard, and that is a brand name, okay? But the banks issue these credit cards, so it's a partnership really between Visa and MasterCard and the banks and the retailers, restaurants, and retail stores that actually accept the cards, okay? So they all partner together, and they all have their hands in your pocket, and so the banks are the ones that actually provide the financing. So a credit card is actually a loan. So credit cards will offer either installment loans or non-installment credit, which is charge cards, where you pay it off every month. Okay, so you have an outstanding balance, and about 2/3 of all credit cards actually have variable rates of interest on them. So you have to be very, very careful when you take out a loan with a credit card. When you're using your credit card, you need to be mindful, and you need to ask the bank, what are the terms of the card, and can I use the card and avoid interest by paying the balance off as quickly as possible, okay? And so credit card debt is often the most profitable, the single most profitable product at a bank, okay? And the reason is they typically have pretty sizable balances on them, okay? And even more importantly, the interest rates on credit cards are the highest rates out there. So you need to be very careful when you're using credit cards because the rates are so high, all right? And then banks will also earn discount fees ranging from 1% to 7% of credit card sales from merchants who accept the card. So keep this in mind. When you use your card at a restaurant or at a bank, not a bank, a retailer, the restaurant or the retailer has agreed to pay the bank a certain percentage fee. And they do that because it is easier to get customers to come in. And when was the last time you went to a restaurant and went to pay with a credit card and they said, we don't take credit cards? Okay? So the bank knows that it's important for the retailer, the restaurant or the retailer, to accept cards, and so they extract a fee. So the banks will earn a fee from the retailer and also charge an interest rate on the loan that they make. So it's a very profitable operation. All right. Because of the explosion of credit cards in the last 25, 30 years, there's been a lot of regulation that's come out. And back in 2003, there was a lot of abuse going on, and the credit card companies, the banks, were marketing to people with below average credit, low credit ratings, trying to get these people to run up their balances, okay? And so Congress jumped in. These people were often charged very high fees, and they were charged very high rates, and they were encouraged to only make low minimum payments. And so these people were taken advantage of. They did not understand what they were doing. And so Congress jumped in because these practices ended up creating significant and severe debt that these people owed and that they couldn't pay back. All right? So in 2009, the CARD Act, the Credit Card Accountability, Responsibility, and Disclosure Act, was passed, and it restricts issuers from raising APRs on their cards. There are a number of dishonest practices that card companies, banks were following, and so laws were written that said, no, you can't do these dishonest things. And if terms are being changed, then customers have to be told that terms are being changed, and the terms that are being changed have to be explained to the customers. Okay? And so the card companies have to post their contracts, their credit card terms, on the internet to make it easy for customers to see what those terms are, and then compare those terms with the terms being offered by other banks. Credit card holders must receive billing statements at least 3 weeks before payments are due, because what was happening was companies were not giving people enough lead time. They were sending bills out, and then they were hitting them with late fees. Okay? Another dishonest practice. Okay? Disclosure must be included on each billing statement that indicated the amount of interest and the consequences of paying just the minimum amount. So these laws were written specifically to address these dirty practices. Okay? Another law that relates to consumer lending, and we've seen it in a lot of different places in this course, the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law by Obama in 2010. And one of the things that it did was it created a new agency, the Consumer Financial Protection Bureau. And boy, the banks were screaming about this one when it was created, but it was needed. And it addresses issues like warning consumers of possible damaging financial practices that could result in financial hardship. So this is a counseling. One of the things they do is they counsel with people. What are things that you should do and things that you shouldn't do financially? Promoting financial literacy. Working with the banks to improve the transparency and clarity of contracts so people understand exactly what they're getting themselves into. And this came about because of credit cards, and it also came about because of adjustable rate mortgages that people entered into. And I'm going to check this and make sure that we're rolling. Give you a close-up here. Yes, we're rolling. We're good. All right. All right. So the financial crisis really shook Congress up, and they jumped into action and passed some pretty good laws. All right. So lenders consider two dimensions of consumer loans. One, they are very profitable, okay, and they're profitable because they're priced very high, which means their rates are high. And so market interest rates on deposits and bonds would have to rise very significantly in order to diminish the profit margin. In other words, the spread between the cost or the charge of a loan, a consumer loan, and the cost of funds is very wide. When you compare the spread on a consumer loan with the spread on a commercial loan, the spread on a consumer loan is much higher. Okay? And then interest rates on consumer loans tend to be very sticky. Okay? There's not nearly as much competition, there's not nearly as much negotiation that goes on a consumer loan as there is with a commercial loan. Okay? And so these loans tend to have high rates that don't change very much even when market rates are changing out there in other areas like for commercial loans. So when rates are falling in the marketplace, they tend not to fall on consumer loans. Let me get that right. And so this works in favor of the banks. So when interest rates in general are falling, consumer rates pretty much stay where they are. But banks have to be careful because when interest rates are rising, it's kind of hard to raise the rates because they're already so high on the consumer loans. Okay? All right, so why are interest rates so high on consumer loans? One reason is that consumer lending is very risky. How do we measure that? Well, the default rate on consumer lending is about 2.5%, and the default rate on commercial lending is about 1%. So 250%, or actually 150% increase in the default rate. So that shows you that consumer lending is 1.5 times riskier than commercial or business lending. Okay? The second thing is banks charge high rates because they can. Because the higher rates really don't do anything to dampen demand for consumer lending. And why is that? Because most Americans are more concerned about the amount of the monthly payment than about the interest rate they're being charged. So when you sit down with a customer or consumer and you say, I'm going to charge you 11% on this loan, and they say, man, that sounds really high, you say, well, your monthly payment is going to be $530 a month on 11%. If I charge you 9%, it would be $500 a month. So it's only $30 a month difference. There's not much difference in the payment amount, and you can afford, based on your income, you can afford to make the monthly payment. And so most consumers will accept that. They look at the monthly payment. They really don't look at the interest rate. And the interest rate doesn't have that much impact on individual customers. So as I said in class, if you're looking at a 30-year, $300,000 house loan, then the interest rate is going to be extremely impactful on the payment. But if you're looking at a 5-year, $30,000 car loan, the interest rate isn't going to make any difference at all on the amount of your payment. All right, and lastly, they make the point that the education and income levels that consumers have will really impact their use of credit. And so the less education and the less income that consumers have, then they're going to use very inefficient, high-cost debt to try to take care of their lifestyle. It's kind of a scary thought. Okay. So, again, as with business loans, when you're trying to analyze a consumer loan, you're going to look at the character of the borrower and the borrower's ability to pay. And of course, as the bank gets larger and larger, they're not going to look much at the character. They're just going to look at the ability to pay. All right? So key indicators that banks look at, okay, when analyzing or assessing should they make the consumer loan: the deposit balances that the customer has. They're going to look at tax returns and pay stubs. Then they're going to look at how stable the people are, how long have they been in their employment, and how long have they lived in their home or their apartment. Okay, and the longer the better. Okay, they're going to look at how much existing debt they have, the amount of debt, the cost of their debt, and the structure, meaning when does that debt come due. Okay, so what is the capacity of the customer to pay the loan back? And it's a function of all these things. Okay, so consumer lenders always check with one or more credit bureaus, and a credit bureau is not a government agency, it is a private company, okay? And they check with these private companies that keep up with the customer's credit history. How much debt and how have they paid? Have they paid on time, okay? And so the big three consumer credit bureaus are Equifax, Experian, and TransUnion. All right, so these are companies that get paid by banks to provide data on the credit history of individuals. Okay? And so a borrower without a credit record, so if you have never taken out credit, then you don't have a credit record at these three companies, and so you're an unknown. And so if you don't have a credit record, or if you have a poor record, you may need to have a guarantor, someone who has assets and income and stability and a credit record, who can sign on your behalf and say to the bank, we will step in if this person does not pay. Okay? So the basic theory of credit scoring, which is what these companies do, okay, is that lenders and statisticians can identify financial, economic, and motivational factors that separate good and bad loans. So there is an algorithm that is put into place that will assess the likelihood of someone being able to pay back a loan. Okay? And so the benefit of credit scoring using this algorithm is that it eliminates personal judgment. It takes personal judgment out of it. And the disadvantage is that it eliminates personal judgment. So your friendly neighborhood bank is no longer a friendly neighborhood bank. It is a black box that uses an algorithm to determine whether you get a loan, how much money you will be loaned, and what rate you're going to pay. It's no longer personal, not based on relationships. All right, so the FICO system is the best known credit scoring system out there. It was developed by a company called the Fair Isaac Corporation. That's why it's called FICO. Okay? And so scores, your FICO score ranges from 300 to 850. And the higher your credit score is, then the less risky you are, and the more credit you'll be able to access, and the lower your rate is going to be. Okay? So the FICO score is based on the 5 types of information below, and they are listed in the order of most important to least important. All right, so the borrower's payment history is the single most important thing. So let me tell you this, folks, that when you have an electric bill, you got to pay it on time. When you have a water bill, you got to pay it on time. When you have a car payment, you have to pay it on time. If you have a medical bill, you've got to pay that thing on time. You've got to be careful. There have been times when I've gotten calls from my bank saying, Ellis, your credit score has gone down. And I say, why? And they say, because you have a medical bill. And I check and I find out it's a $30 bill from an office visit from 3 years ago that just fell between the cracks. And so I'll call the doctor's office and say, hey, check, tell me if you owe $30 from 3 years ago. I'm like, oh, for crying out loud, let's get this thing taken care of. And that can really hurt your credit history. Okay? All right, the amount that you owe, the total amount of debt that you owe, and that's going to be your house, the debt on your mortgage debt, and it's going to be your car debt, and it's going to be your credit card debt. Okay, anything that you owe. Your student loans will be on there. All right. All right, the length of your credit history, the longer the history, the better they feel about you. Okay. All right. The nature of the amount of credit that's being requested. How much credit are you requesting? Are you trying to get? What is the use of the credit? And what are the terms of the credit? All these things are important to your credit score. Okay? The types of credit that you've used in the past, and that you still have on your books, really important to your credit score. Whoops. Yikes. Bear with me. Looks like we don't have, I'm not sure what happened to our animation here. We should have animation here, but it looks like we don't, so let's make sure we have animation here. Where's our animation pane? Bear with me here. Alright. Let me get this thing working. Yeah, that works. That works. Alright, so here's where let's get all these things going here. Sorry about this. Just bear with me for 1 second. This is a new chapter. Alright, let's see what we got here. Let's get all these things copied in here. Almost done, almost done. Where did that go? Bear with me here. Almost finished with it. Hopefully this will be it. So click. Here we go. I missed one. That's all right. So you know that rules and regulations continue to be passed, and so here are the latest things. And the rules and regulations typically fall into, I think it says 4, but I actually think it's 3 categories. We'll see. All right, the first is disclosure rules. Disclosure rules. Tell the customers about the cost and the terms of a loan. Okay? And so here are some acts that deal with that. The Truth in Lending Act, the Fair Credit Reporting Act, the Fair Credit Billing Act, and the Fair Debt Collection Practices Act. So you can see from the titles what the effort is, what the focus is of these different acts, but they're all about telling consumers the costs and the terms of a loan. Then there's anti-discrimination legislation, and this prohibits categorizing customers according to their age, sex, race, or other what they call irrelevant factors, or denying credit. You can't classify them, and you can't deny credit because they fall into one of these groups. It's against the law. And so there have been lots of lawsuits that have been brought against banks. Okay? Then there's so in this area of anti-discrimination, the more important acts are the Equal Credit Opportunity Act and the Community Reinvestment Act. And then there's predatory lending. Okay? These are bad practices. So these are laws that try to limit or address bad practices like charging excessive fees or rates or selling unnecessary products. Can you say Wells Fargo, for example? Let's make sure this thing is going. Yeah, we're still going. All right. Wells Fargo sold unnecessary products such as insurance, particularly to consumers with below average credit scores. So be careful when you check your balances and check your checking account. Make sure that you know where all of your charges are going. And so the Home Ownership and Equity Protection Act of 1994 was one of the acts that had to do with predatory lending. All right, let's shift over and look at real estate. Okay, real estate loans. So real estate loans are used to finance the development or the purchase of homes, apartment complexes, shopping centers, office buildings, raw land. Notice that agriculture is not in here. That is a different type of loan altogether. Okay? And real estate loans tend to be kind of unique. Okay? First of all, the average size of a real estate loan, and remember we're talking about more consumer-oriented real estate loan, more consumer-oriented loans in this chapter. So The average size of a real estate loan is large. It's typically, for the typical individual or family, it's the largest loan that they'll ever take out, okay? And they also tend to have longer maturities than other types of loans. So a car loan, 4 or 5 years, a home loan, 15 to 30 years, okay? Okay? With real estate lending, there's a big focus on the condition and the value of the subject property. Of course, they look at income, like they do with all loans, the capacity to pay, but they also look at the condition and value of the asset that is being financed. Okay? So that makes real estate lending really, really unique. All right, so unique aspects of real estate lending. And appraisals on the property are critical to the loan decision. Okay? And these appraisals have to meet industry standards and government regulations. And yes, appraisals became a source of difficulty and challenge back in the financial crisis. A lot of bad appraisals were done, and they were done in order to generate fees for appraisers. So the appraisal business is a pretty sizable industry. You have to take exams and be certified to be an appraiser, and then you're going to either work for a bank or you're going to be independent and you're going to do work for a bank, okay, or for an insurance company to get an understanding of what properties are really worth. All right, so what do lenders look at when they are assessing an application for a real estate loan? Well, the first is how much down payment is the borrower able to put in on the property, okay? So we're looking at the ratio of the down payment to the purchase price of the property, okay? And this is called the loan-to-value ratio, all right? And the higher the loan-to-value ratio, the higher the bank is, the more money the bank is lending compared to the value of the property, okay? The riskier the loan is, okay? And which means if the borrower is not putting a bunch of money in, then they are going to be less inclined to honor the terms of the loan, to pay the loan off, okay? Now, lenders may be willing to give a mortgage loan customer a lower interest rate. This is something that comes in to the negotiation. You're more inclined to get the loan, you're more inclined to get a lower rate if you put a higher down payment down, and if you agree to use other financial services. Remember that CPA approach to valuing customers, okay? So other things that the lender looks at, the amount and the stability of the borrower's income, that's always there. How much savings a borrower has, so you're going to be asked about your balance sheet. You're going to have to create a balance sheet. And you're going to be asked, how are you going to fund the down payment? Do you already have it, or is somebody giving it to you? Okay. Do you have a history of taking care of property? Have you owned houses in the past? Okay. And of course, when a bank looks at the property and looks at the appraisal, they're going to take into consideration what's going on in real estate in the local market. Because if they have to repossess that property, they're not going to hold it. The bank doesn't want to hold that property on their balance sheet. They want to sell that property. So they want to make sure before they loan you money that, that there's a really good case to be made that they'll be able to sell that property for a good price. If they have to, if they have to repossess it. Man, this is challenging. All right. Okay, let's look at interest-only loans and adjustable rate mortgages and the mortgage crisis that happened back in 2008, 2009. So back when real estate, the last big real estate boom, we're back into it. Prices are high again, but the last peak was 2007, 2008, and prices were soaring, okay? And lenders were trying to figure out how they could make high-priced homes affordable. They wanted to keep the game going, all right? How could they make mortgages more accessible to families of modest means? And the way they did this is they encouraged people to sign up for adjustable rate mortgages called ARMs, adjustable rate mortgages, okay? And the sad thing is that interest rates were very low at the time, and prices were very high for homes. And they're related, folks. When interest rates are low, house payments are lower, and so people will throw more money at a house. They'll bid the price up because the interest rate is low, and the house payment will be low, so they can afford to pay more for a house. So you had very low interest rates, you had very high home prices, and people were taking out adjustable rate mortgages when interest rates were low. So think about it this way. An adjustable rate mortgage is a mortgage whose rate is going to move with market rates. And if interest rates are historically low, are the odds better that rates are going to go down or that rates will go up? And obviously, the odds are rates will go up. And people did not take that into consideration as they took out these adjustable rate mortgages. Okay? So another financial innovation that was used was the interest-only adjustable home mortgage loan, otherwise called an option arm. And so this combined two really bad ideas. Okay? An interest-only loan on a piece of property, on a house. Why would you do that? Well, if you're with an installment loan, a level pay amortizing loan, you're paying principal and interest. If you take out an interest-only loan, you're not paying any principal, so what happens to the payment? It goes down. That's why people do it. So they combined adjustable rate mortgage with interest-only mortgage, and they came up with the option arm. Bad, bad idea. So the borrower only pays the interest on the loan for an initial period, and then after that period, then you start paying interest and principal. And again, what are you trying to do? You are trying to lure people into borrowing money and purchasing a home at the lowest possible price or cost up front, but then you hammer them down the road. Bad idea. Okay, and so this was considered to be predatory lending because it was done to people who had low income, below average credit, and low education. They didn't know what they were getting themselves into. Okay? So in an environment of rising market rates, so after a lot of people piled into these products, okay, interest rates started going up, and house payments went up very significantly. And another thing that these companies did was they hired appraisers that gave very high appraisals, okay? And so the banks did not require, they did high loan-to-value ratios, loans, and so these people did not have a lot of their own money into these homes, and they walked. They walked. They took the keys, brought them back to the bank. All right. So Dodd-Frank was enacted in part because of this, and we just looked at Dodd-Frank, but let's look at it again. Key provisions of Dodd-Frank, again, having to do with home mortgages, is that the terms of a mortgage loan have to be disclosed and explained, okay? And you cannot represent that a loan has fixed terms when terms can actually be changed, so you have to be very careful with that. When you write a law like this, if the law is violated, people can be prosecuted and sued. That's a big purpose of the law. And this is interesting, and this is something I didn't know about. Lenders who are pooling and securitizing mortgage loans that they create and sell are responsible for at least 5% of the credit risk. So what that means is that if a mortgage lender makes a loan, sells the loan, they still are on the hook for 5% of any credit losses, at least 5%, that are attached to the mortgage that they sold. What does that mean? That means that lenders have to pay closer attention to the people they're loaning money to. That's what it means. So that's a really cool thing. I love that idea. Okay? So before that, lenders had no responsibility or accountability, and so as long as the loan met the underwriting standards of the agency that was purchasing it, the lender did not really do their due diligence. Okay? So a lot of bad loans were made. All right, so during the crisis, a lot of households sought protection okay, from creditors, from the banks, under the U.S. Bankruptcy Code. The problem was, and remember that the credit crisis, the mortgage crisis, happened in 2008. In 2005, under the Bush administration, they cracked down on some of the bankruptcy laws because they were too relaxed. They were too easy. And so they made filing for bankruptcy more expensive and time-consuming. Okay, so they made it tougher on people to file. Okay, and so you have to go through a process of completing a counseling program. So it's not easy to file for bankruptcy. And the goal was to discourage consumers from taking on too much debt. And as I say in here, it didn't work. Okay, this law did not work. A lot of predatory lending went on. A lot of bad decisions were made by consumers. They took on those adjustable rate mortgages and those interest-only mortgages and borrowed too much money and didn't put enough money down. And the banks and consumers got into big trouble. All right, let's go ahead. As I said, here we go again. This will be easier though. This will be quick. New chapter. All right, let's get this done. There we go. All right. So there are two forms of bankruptcy that I want you to be familiar with. The first is called Chapter 7, and it is a liquidation, and it is the more serious form of bankruptcy, Chapter 7. And under Chapter 7, the court, there's a bankruptcy court, a separate court that is set up for bankruptcies. They take possession of all of your assets, and they sell all of your assets, and then they use the proceeds to pay the debt that you owe. And of course, debtors are either senior or junior, which means where are they in line? Are they in front? Are they going to get paid first or second? Okay. And if the proceeds from selling the assets are insufficient, then people who are owed money are not going to get paid. And that's the way it is. Everybody loses. Okay. And then the second type of bankruptcy is Chapter 13, and it is called a reorganization, not a liquidation. Okay. So the filer, the person who files for bankruptcy, keeps their assets and files a plan that the court approves, and the bank works with the lenders to reschedule the debt. Okay? And the filer will typically pay either part or all of the debt, but they reschedule it so that the filer has the more time, lower payments, and has the capacity to pay that debt off. So Chapter 7 or Chapter 13. And so a means test is done to determine if you file under Chapter 7 or Chapter 13. And what this means is, well, let's go ahead and let me show you the definition of this. So the means test is an average of the debtor's past 6 months of gross income. So what is the capacity of the filer to pay? And so the test is done to determine if the filer can pay. If the filer can pay the debt, then they can't go through Chapter 7. Okay? This is done to keep people from trying to avoid their debt when they can actually afford their debt. That's what this is. Okay? So if you have enough income, you're not going to be able to file Chapter 7. You're going to have to file Chapter 13 and pay your debt. That's what this is. All right, just a couple more slides. Okay. So some other terms that you need to be familiar with in banking: the annual percentage rate, the APR. We go over this in ManFin, and it is defined in the Truth in Lending Act. Okay, so it's a specific formula. Whoops. And lenders have to give the borrower a statement that states and specifies what the APR is, so that the borrower knows exactly what their APR is. And the APR is the annualized, it's an annualized number, an annual number, and it's the internal rate of return that equates the total payments with the amount of loan. So basically, it is the internal rate of return, and it is one way to compute what the rate is on a loan. And it's a formula that is standard. It's a formula that is accepted by all the banks because it's standard, because it's accepted by all the banks, then a customer can compare the APR for different loans and understand how to do the comparison. Okay? All right. I don't really like that. We're not even going to look at that. All right. So comparison is the important thing. Let's see what we have here. Then we have simple interest. Oh, man. I made some changes to this thing, but that's all right. We'll go ahead and do it this way. So simple interest is when you take the rate times the principal times the amount of time to determine how much your interest charge is going to be. Okay? That's not really important. Then you have the discount rate method. Okay? With the discount rate method, when you go to the bank and you take out a loan, they say, okay, we're going to loan you $100,000 and it's going to cost you 10%. So you pay $10,000, so they loan you $90,000 and they take $10,000 out of it and you pay the interest up front. Okay? That's what the discount rate method is. And then under level pay amortizing, it's an installment loan, okay? And it's a fixed payment on a regular schedule that includes interest and principal. Okay? Interest is computed for each period and is separated from the payment. Okay? Now, let me say this. I made some changes in this chapter, and I am going to post the changes that I made. In fact, I'm gonna stop this right now because I want you to see the changes that I made. It's important. So bear with me. I'll be right back. All right, let's start over with this slide 16. I made some good changes in this chapter. I want to make sure that we capture this in the video. So let's start over with chapter 16, starting with slide 16, starting with the APR, the annual percentage rate. All right, so under the Truth in Lending Act, a legal definition of APR is listed, and lenders must give the household borrower a statement that contains or specifies the APR. Okay? And they do that so that the customer understands what they're paying and so that the customer can then compare that APR with offers made by other lenders. So the APR is an annualized internal rate of return that equates the total payments with the principal of a loan. It is a standard way to determine a rate of return. And so if you're using your Texas Instruments calculator, you put in the amount you're borrowing, you put in your payment, you put in your term or your in, and you compute IY, and it's going to give you the period IY, might be for a month, and then you multiply that by 12 and you get an annual IY, and that annual IY is your APR. So it's a standard way of computing a rate of return. And so the primary purpose of the APR is to allow borrowers to compare loan rates. Okay? So it is important to note that the APR does not include the effect of compounding. So because with home loans that are done on a monthly basis, there are 12 compounding periods per year. Your APR is one number, but your effective annual rate is a higher number. It takes into consideration compounding. The APR does not take compounding into consideration. Okay, the effective annual rate does. And so the more compounding periods there are in a year, then the higher the effective annual rate is going to be. However, if you're comparing two loans that are both compounded the same number of times per year, 12 in this case for a home loan that's paid monthly, then you can use the APR as the basis of your comparison. Okay? All right, so simple interest is calculated as rate times principal times time. Okay? And so it does adjust for the length of time that the borrower is using credit. Okay? And this is the method, this is the most important aspect of interest only, or I'm sorry, of simple interest, is that this is how interest only loans are computed. Okay? So the rate times the amount that's outstanding times the time that the loan is outstanding. All right, then we have what's called the discount rate method. And with this discount rate method, the interest is subtracted up front from the loan amount. Excuse me. So the amount loaned is after interest is actually deducted. And then there is the level pay amortizing loan, the most commonly used type of loan. And this involves a fixed payment that includes both interest and principal. And interest is computed for each period and is separated from the payment. So the payment consists of interest and principal that are separated out, and whatever is left of the payment after interest comes out is applied to reduce principal. Whoops. So this method is used with longer installment loans such as permanent financing for real estate and also for auto loans. The installment, the level pay, the installment level pay amortizing loan. All right, let's look at the Rule of 78. Okay, the Rule of 78, it might be the rule of the sum of the number of months of loan. 78 is when you take the 12 months, when you take a 12-month loan and you add the numbers 1 through 12 together, you come up with 78. So what it's used for, excuse me, it's a rule of thumb to determine how much interest income a lender is entitled to receive at any point in time. So I'm going to give you an example. This method favors lenders by putting more weight on interest paid in early periods of a loan. I'm going to give you an example and it's going to highlight it for you. So it front-end loads interest. This is all about a customer who wants to prepay a loan. If they prepay a loan, how much interest will the lender be able to keep? How much interest will the customer be able to avoid by prepaying a loan? So this is when this comes into play, when a borrower wants to pay a loan off. So determine the customer's interest rate from an early repayment. You total the digits for the months remaining in the loan, and then you divide that sum by the sum of all of the months originally in the loan. So let's look at an example. Okay. All right, example. A customer requests a 1-year loan to be paid in 12 monthly installments. Okay. The customer would like to repay the loan after 9 months. They want to prepay, they want to avoid interest on 3 months. Okay. The interest rebate that the customer is entitled to receive back is equal to 1 plus 2 plus 3. That's the number of months remaining. So that's 1 plus 2 is 3. 3 plus 3 is 6. Okay. So that's the numerator. And then 1 through 12 added up is the denominator, the rule of 78. Okay. So 6 divided by 78 times 100. The customer will avoid 7.69% of the total amount of interest that would have been paid. So they're trying to avoid 25% of the interest, but they're not going to be able to avoid 25% of the interest. To protect the lender, they're only going to avoid 7.69%. I want to make sure that we're rolling, and yes, we are rolling. All right. So the lender is going to keep 100% minus the rebate, 92.31% of the interest. Okay, and I give you an example in the homework, another example at work. All right, other issues. Charging the customer mortgage points. What is a mortgage point? Okay, so a home mortgage loan agreement will often require borrowers to pay an additional charge upfront, and it's called points. All right? Points are considered to be prepaid interest, and they may be deductible as home mortgage interest. So you have to pay them, but you might be able to, but you can deduct them. All right, here's an example. A borrower seeks a $100,000 home loan, and the lender assesses the borrower an upfront charge of 2 points. So here's the calculation, the dollar amounts of points. It's a real straightforward calculation. The amount of the mortgage loan, 100,000 times the number of points charged by the lender. So we got $100,000 times 2%, $2,000. Now, sometimes in a negotiation, the lender will offer to lower the interest rate on a loan if the borrower pays an additional point or two. So you might be able to go from a 5% rate to a 4.5% rate if you pay 2 points. Okay? So sometimes points are just a charge, a cost that is added to the loan. Sometimes points are used to what's called buy down a rate. Okay? Let's look at the mechanics of a level pay amortizing loan, and we'll finish up with this. Okay, assume you want to borrow $300,000. The terms are 4.5% APR for 30 years, payable monthly. Okay? First, determine the monthly payment, and we're going to use our Texas Instruments BA2 Plus. Okay? So, $300,000 is our present value. 30 years times 12 payments per year, 360 is our in. 4.5 divided by 12, 0.375 is our IY. And compute our payment. And we get $1,520. This is our payment. All right. Now let's create an amortization table that will illustrate principal and interest each month. Okay? Please note that to determine the interest for each period, you divide the APR by 12, and then you multiply by the beginning balance. So multiply the APR divided by 12 times the beginning balance to get your interest charge for each period. We'll look at that. To determine the amount of principal that you reduce each period, you subtract the interest that you just calculated from the payment, and whatever is left over is subtracted from the payment. Okay, so let's look at it. So we have the payment number, the beginning balance. So the beginning balance is $300,000. The payment is $1,520. Okay. The interest charge in the first period is $1,125. How did we get that? Okay. So we divided our 4.5. Now we're doing a calculation. So it's not going in the calculator in the financial keys. So it's 0.045 divided by 12, which is 0.00375. That's the monthly interest rate. This loan of $300,000 is outstanding for 1 month, so we're going to take 0.00375 times $300,000, and we get $1,125. We subtract $1,125 from $1,520, and we're going to reduce principal by $395. So take the $395 from the beginning balance of $300,000, and we get $299,605. That's our ending balance, which just so happens to be the present value of 359 payments remaining at 4.5% annually, done on a monthly basis. All right. Here's our new beginning balance. Payment stays the same. Our interest charge has gone down. Why? We take the 0.00375 and we multiply it by the new lower principal. And that comes up with an interest charge of $1,123.52. We subtract that from the $1,520, and we're going to reduce principal by $396.48. So we take the $396.48 and subtract it from the $299,605, and we come out with $299,208.52. Okay? All right. So, again, this ending balance here reflects the present value of the remaining payments. So we've got 358 payments left at 0.375 IY. 358 is our in. 1520 is our payment. Compute present value, and you're going to get $299,208.52. All right. The last thing I would tell you is, if you want to know how much interest you're paying over the life of the loan, take the $1,520 payment, multiply it by 360 payments. You're going to make 360 payments of this, and you get the total amount of money that you're paying back to the bank. Subtract the $300,000 that you are borrowing from that, and the difference between the total amount of money you're paying back to the bank and the $300,000 that you borrowed, that difference is the amount of interest that you're paying back to the bank over the life of the loan. All right, so there you have it. We are done. I hope you enjoyed the course. I hope you learned a few things about banking, and I hope you have a great summer. See you at the final.